Did you know markets are currently pricing a 35% chance of a U.S. recession in 2026? That's a significant signal. In this video, you'll learn to identify key recession warning signs and discover 5 actionable steps to protect your wealth, even if a downturn doesn't materialize. If you find this information valuable, consider subscribing for weekly breakdowns of complex financial topics. And let us know in the comments, what's your biggest worry about a potential recession? All right, let's talk about those early warning signs. The yield curve, which normally slopes upward, has inverted and is now re-steepening. Think of it like this. Investors are demanding higher interest rates for lending money long-term than short-term, which historically signals economic trouble ahead. According to the Federal Reserve, an inverted yield curve has preceded every recession since 1970. Then there's the SOM rule. This is economist Claudius Somm's simple but powerful indicator. If the unemployment rate rises by half a percentage point above its 12-month low, it's a recession flag. The Conference Board's leading economic index also shows contraction, and credit card delinquencies are at a 12-year high, according to data from Fred. These aren't calls for panic, but for smart planning. The ISM Manufacturing Purchasing Managers Index, a key barometer of industrial health, has now contracted for 4 consecutive months. When this index falls below 50, it signals a decline in manufacturing activity. This sustained downturn is a significant indicator of economic cooling. Furthermore, consumer credit card delinquencies, specifically those 90 days or more past due, have climbed to a 12-year high. Data from the Federal Reserve Bank of New York shows this rate is now exceeding levels seen in the lead-up to previous economic downturns. What does this surge in unpaid debt tell us about the broader economy? These two metrics, the contracting manufacturing PMI and the escalating credit card delinquencies, act as powerful confirmation signals. They paint a clearer picture, suggesting that the economy is indeed slowing down, aligning with other indicators like a flat yield curve and the SOM rule flashing yellow. This isn't about predicting the future with certainty, but about recognizing the patterns that have historically preceded economic contractions. The traditional advice for an emergency fund often suggests having 3 months of living expenses saved. However, in today's economic climate, this may no longer be sufficient. Markets are currently factoring in a roughly 35% probability of a U.S. recession in 2026, a sentiment echoed by indicators like a flat yield curve and rising consumer credit card delinquencies, which are at their highest point in 12 years. This isn't meant to cause alarm, but rather to encourage proactive planning. To better prepare for potential economic downturns, a more robust emergency fund is recommended. The new target for this financial cushion is 6 to 9 months of essential expenses. This buffer should be held in a high-yield savings account, which currently offers an annual percentage yield (APY) of over 4%, a significant improvement compared to the near-zero interest typically earned in a standard checking account. Calculating essential expenses is key. This means focusing on necessities like housing, utilities, food, and debt payments, rather than discretionary spending. As of May 2026, high-yield savings accounts are providing rates in the 4.2% to 4.5% APY range, making them an attractive place to park this crucial fund. The current financial landscape suggests a heightened possibility of a recession in 2026, with markets indicating approximately a 35% probability. This isn't a cause for alarm, but rather a signal for prudent planning. Several economic indicators are flashing cautionary signs. The yield curve, after inverting, has begun to re-steepen, a pattern that has preceded past downturns. The SOM rule, which monitors unemployment increases, is also showing a yellow flag, and the Manufacturing Purchasing Managers Index, PMI, has remained below 50 for 4 consecutive months. Furthermore, consumer credit card delinquencies are at a 12-year high, as reported by the Bureau of Labor Statistics. These are not isolated events. They collectively point to a need for strategic adjustments to protect accumulated wealth. One of the most effective steps in this proactive approach involves optimizing the emergency fund. The traditional 3-month guideline is now considered insufficient for recession preparedness. A more robust target is to maintain 6 to 9 months of essential living expenses. Where should this enhanced buffer be held? Traditional checking accounts typically offer a negligible interest rate, around 0.01%. In contrast, High-yield savings accounts, HYSAs, as of May 2026, are offering competitive annual percentage yields, APYs, exceeding 4%, with some reaching 4.2% to 4.5%. Calculating essential expenses, focusing strictly on necessities like housing, food, and utilities, rather than discretionary lifestyle spending, is the first step in right-sizing this critical cash reserve. Consider this. If an individual has $5,000 in monthly essential expenses and aims for a 6-month emergency fund, that's a $30,000 buffer. At a 0.01% interest rate in a checking account, that $30,000 earns a mere $3 annually. However, parked in a HYSA offering 4.2% APY, that same $30,000 would generate approximately $1.260 in interest over the year. This significant difference highlights the power of strategically placing emergency funds where they can earn a meaningful return, especially during periods of economic uncertainty. This enhanced earnings potential not only preserves purchasing power but also provides a tangible benefit from funds set aside for unexpected events. When economic contractions loom, certain market sectors tend to show resilience. These are often the industries people continue to patronize, regardless of their financial situation. Think about consumer staples, the companies that produce everyday necessities like food and beverages. During the 2008 financial crisis, for example, the Consumer Staples Select Sector SPDR Fund, XLP, saw a decline of just 11%, while the broader S&P 500 fell by 38%. Healthcare is another sector demonstrating this defensive characteristic. People still require medical attention and prescription drugs, making healthcare services and pharmaceuticals less susceptible to economic downturns. Similarly, utilities providing essential services like electricity and water tend to be stable. In 2020, amidst the pandemic-induced recession, the Utilities Select Sector SPDR Fund, XLU, actually posted a gain of 4%, contrasting sharply with the S&P 500's 1.6% loss. On the flip side, sectors tied to discretionary spending often contract more significantly during recessions. Consumer discretionary stocks when economic cycles turn, certain sectors are more vulnerable than others. Consider cyclical sectors like consumer discretionary, industrials, and financials. These industries are highly sensitive to economic fluctuations. For instance, during economic downturns, consumer spending on non-essential items like new cars or dining out often plummets. Similarly, industrial production slows as businesses scale back on expansion and investment. Financial institutions, too, can face increased loan defaults and reduced lending activity. Why does this happen? These sectors are often the first to see reduced demand when consumer confidence wavers and discretionary income shrinks. Take the consumer discretionary sector, XOY, for example. In the 2008 financial crisis, XOY saw a decline of over 40%. Conversely, some sectors tend to weather recessions more effectively. These are known as defensive sectors, including consumer staples, healthcare, and utilities. Consumer staples companies provide essential goods like food and beverages, which people continue to buy regardless of economic conditions. Healthcare services and pharmaceuticals are also in consistent demand. Utilities, providing electricity and water, are likewise necessities. Historically, during the 2008 recession, the Consumer Staples Select Sector SPDR Fund, XLP, experienced a much smaller decline, around 10%. Therefore, a strategic approach involves reducing exposure to these more volatile cyclical sectors during periods of heightened recession risk. This doesn't mean eliminating them entirely, but rather making a deliberate shift. For a portfolio typically balanced 60% stocks and 40% bonds, a tilt of 10 to 15% towards defensive sectors can provide a buffer. This reallocation aims to protect capital by emphasizing areas that historically demonstrate greater resilience when the broader economy contracts. As recession probabilities begin to climb, understanding the current landscape for fixed income investments becomes crucial. With the Federal Reserve anticipated to lower interest rates to counter an economic downturn, the yields available today on various fixed income instruments present a distinct opportunity. This period offers a valuable window to secure attractive returns before rates potentially decline. Consider the current yields. Short-term Treasury bills are offering rates around 5%, a significantly higher return than typically seen in recent years. Similarly, certificates of deposit, or CDs, are providing competitive rates, with one-year terms yielding approximately 4.7% as of early 2026. Even longer-term investments like 10-year Treasury notes are currently yielding around 4.4%. These figures represent a notable shift from the near-zero interest rate environment of the past decade. What's driving these attractive yields? The market is anticipating a shift in monetary policy. When economic conditions weaken, central banks often reduce interest rates to stimulate borrowing and spending. This proactive measure, intended to mitigate recessionary impacts, typically leads to a decrease in yields across the fixed income spectrum, particularly for shorter-term securities. Therefore, locking in these current rates through strategic investments could prove beneficial. For instance, building a treasury ladder is a sound strategy to capitalize on this opportunity. This involves purchasing treasury securities with staggered maturity dates, perhaps 12-month, 24-month, and 36-month rungs. When each shorter-term security matures, the principal can be reinvested at whatever the prevailing rates are at that future time, potentially at even higher levels if rates have continued to rise. This approach helps to smooth out interest rate risk and capture current yield advantages. Buying these securities directly is accessible through platforms like treasurydirect.gov. A strategy to consider for securing current yields is building a treasury ladder. This involves purchasing U.S. Treasury securities with staggered maturity dates. For instance, one might buy Treasury bills maturing in 12 months, 24 months, and 36 months. Why is this beneficial? When the Federal Reserve begins cutting interest rates to combat a recession, short-term yields tend to fall more rapidly than longer-term ones. Currently, yields on short-term Treasuries are quite attractive, with 3-month T-bills offering over 5% and 1-year CDs around 4.7%, while 10-year Treasuries stand at approximately 4.4%, as of May 2026 data. By constructing a ladder, an individual locks in these higher yields across different time horizons, providing a predictable income stream even as market rates decline. This can be accomplished directly through Treasury Direct, the U.S. government's savings bond and Treasury bill purchasing portal, making the process accessible. Isn't it interesting how market expectations can shift so quickly? Just a few months ago, the narrative was very different, yet here we are, considering recession probabilities. This latter approach offers a tangible way to benefit from today's rate environment before potential changes occur. When economic downturns loom, job security often takes a hit. Layoffs become a real concern, making a secondary income stream a crucial form of protection, much like insurance for one's livelihood. Consider the possibilities: leveraging specialized skills on platforms like Upwork, where in March 2026, top freelancers in niche areas were averaging over $75 per hour. Another avenue is cultivating a dividend-paying investment portfolio. For instance, a portfolio yielding a consistent 3% could generate between $200 to $500 per month, with a principal of $7,000 to $20,000. Alternatively, establishing a recession-proof side hustle, such as offering tutoring services or freelance writing in high-demand fields, can provide a stable financial buffer. What truly distinguishes these income streams during a recession is the underlying mindset. It's not about accumulating wealth for its own sake, but rather about building resilience and mitigating risk. Think of it as creating a financial safety net that allows for greater peace of mind, regardless of market fluctuations. Did you know that during the 2008 financial crisis, many individuals who had diversified their income streams were better positioned to weather the economic storm? This proactive approach transforms a potential crisis into a manageable challenge by ensuring that a single source of income disruption doesn't derail financial stability. During economic downturns, the urge to react impulsively can be overwhelming. However, 3 common reactions often inflict the most damage on long-term financial health. The first is panic selling. Data from J.P. Morgan's Guide to the Markets, Q2 2026, reveals that a significant portion of bear market gains, around 25%, materialize within the first 10 days of a recovery. Selling at the bottom means missing out on this crucial rebound potential. Another costly mistake is halting contributions to retirement accounts like 401(k)s. Think of it this way: when the market is down, contributions effectively buy assets at a discount. Continuing to contribute during a downturn is akin to buying quality goods when they are on sale. Furthermore, indefinitely hoarding cash, while seemingly safe, is a silent wealth destroyer. Inflation, even at modest rates, erodes purchasing power over time. For instance, if inflation averages 3% annually, $10,000 today will only be worth about $8,000 in purchasing power a decade from now. Instead of succumbing to these panic moves, a disciplined approach is key. This involves staying invested according to a well-thought-out plan and resisting the urge to time the market. Strategic rebalancing, perhaps once per quarter, can help maintain the desired asset allocation. A practical strategy for those with a significant cash buffer might involve gradually redeploying that cash into equities if the S&P 500 experiences a substantial drawdown, such as 20%. This approach balances caution with the opportunity to capitalize on market dips.